The promise of global expansion. I mean, the thought of tapping into these dynamic, fast-growing markets, especially across Asia, it's one of the biggest drivers for ambitious companies today.
Oh, absolutely. It's growth, it's market share, long-term stability.
But if you've started to take that leap, you know that beneath the surface of all those exciting headlines, there's just this dense jungle of complexity.
It's so true. I mean, everyone discusses the visible stuff, right? The trade tariffs, the basic supply chain
It's
bottlenecks.
things you see on the news.
Exactly. But the truly destabilizing factor, the pressure that can silently undermine years of hard work, is the compliance environment.
Hmm.
It's not just about a list of rules. It's about, unspoken expectations.
Hmm.
And the goalposts are constantly moving, sometimes even retrospectively.
That is the perfect analogy, and
Yeah.
that's really our mission in this deep dive. We are unpacking the compliance pressures that trip up even the most established global operations.
Right.
We're moving beyond the basics to look at the subtle, high-stakes areas, all drawn from that stack of sources you shared with us. We want to give you those concise, impactful nuggets you need to stay ahead.
And we've boiled the sources down into really four major pillars of pressure. Any company scaling internationally has to address these with some urgency.
Okay, what's first?
First, we have the rapidly evolving international regulatory landscapes. Think AI governance, competition law, export controls, where new rules are popping up almost weekly.
Then we're going to shift to the powerful, growing scrutiny on foreign subsidies.
Yeah.
This area has become a massive new risk, particularly for non-EU companies trying to enter the European market.
Third, we'll look inward at the critical need to combat global corruption. That's enforced through these really strict frameworks like the US FCPA and the UK Bribery Act. This is all about reputational risk management.
And finally, we're going to zoom right in on the operational reality, the specific tax pressures for your key people on the ground. We'll highlight the intricate dance around individual income tax for expats in big hubs and what that famous 6-year rule in Shanghai actually means for your teams.
Okay, so let's unpack this new international rulebook. What's fascinating here is just the sheer speed of regulatory change.
And when companies are so focused on aggressive scaling, these competition laws or antitrust rules, they often become an afterthought, which is just a massive mistake.
It absolutely is. Jurisdictions everywhere are moving way past simple merger control. They're getting much more sophisticated about market fairness.
How so?
Well, regulators are deeply scrutinizing pricing strategies, they're monitoring how data is shared between competitors, and they're looking at exclusionary practices. The sources really emphasize that global companies need to be incredibly vigilant.
Because what's standard in one place could be collusion somewhere else.
Exactly. What might be seen as standard collaboration in one market is viewed as anti-competitive collusion in another, and the difference can be millions in fines.
And if you're in the tech sector, you're not just dealing with old-school competition law. You've got the simultaneous explosion of AI governance moving at lightning speed.
This is maybe the hardest area to master. The tech just changes faster than the laws can keep up.
Right.
And what's critical to understand is that the conversation has moved way past basic GDPR-style data protection. The new rules are focusing heavily on preventing bias in algorithms, ensuring transparency in how AI systems make decisions.
Explainability, they call
All
it.
right, explainability, and establishing a clear line of accountability for when these powerful systems, inevitably fail.
Can you give us a concrete example of where this bias and lack of transparency really hits hard in compliance?
Sure. Think about AI used in high-stakes HR or finance hiring software, for instance, or credit scoring models.
Mhm.
If an algorithm is trained on biased historical data, it just perpetuates those biases. That leads to discriminatory outcomes. Compliance now requires you to prove that you have actively mitigated this risk.
Which means sophisticated testing, auditing the data.
Yes. It's not just a technical fix. It requires a whole legal and ethical compliance framework.
That seems like an almost impossible task for a mid-sized firm. It's a huge ongoing investment.
It is, but it's non-negotiable if you plan to operate internationally. And speaking of controls, we also have the increasingly complex landscape of overseas export controls.
Okay, this is where the regulatory friction really starts to impact manufacturing and distribution, right?
Precisely. If your business manufactures, distributes, or even just uses advanced technology, dual-use items, sensitive goods, you are immediately in this dense web of regulation.
And it's not just military hardware we're talking about.
Not at all. It's specialized components, advanced machine tools, even software.
I remember the sources highlighted a specific sector example here.
Yes, the medical device company. Let's say they produce high-tech diagnostic scanners. Well, because that equipment has advanced semiconductors or specific sensors or even proprietary AI for image processing.
It could be classified as dual use.
You got it. And that classification triggers a requirement for specific export licenses, detailed lists of controlled items, strict end-user declarations to prevent unauthorized diversion.
So you have to be proactive.
You have to be. The sources are clear. You need to build adaptive compliance systems that track everything. Products, components, purchasers, long before a shipment ever leaves the factory floor. Being reactive here just means you're already too late.
So we got these fast-moving tech rules.
Yeah.
But here's where it gets really impactful for any company with foreign origins looking to expand in Europe.
Yeah.
The growing scrutiny on foreign subsidies.
This is arguably the biggest, newest regulatory bomb to drop on global business, the EU's Foreign Subsidies Regulation, the FSR. It is a monumental piece of legislation. It's designed specifically to level the playing field by scrutinizing financial support that non-EU companies get from their home governments.
So we're talking about grants, loans, tax breaks.
Any government contribution that could potentially distort the European internal market?
And the reach of this regulation is what really caught my eye in the source material.
Wow.
It's not just about what's happening today, is it?
That's the critical detail. The FSR has extraordinary retroactive power. It can look back up to 5 years before its implementation date.
Wow.
Meaning financial support your company got years ago, which seemed perfectly fine then, might now be flagged as market distorting in an M&A deal.
And if a company gets this wrong, what are the stakes? Is it just a bureaucratic headache?
Far from it. The consequences are, well, they're existential. Non-compliance can result in truly staggering fines, potentially up to 10% of a company's global turnover.
10%. That's not a business interruption. That's a fundamental threat to the company's entire balance sheet. And we've already seen the regulators start to move on this. I remember reading about that raid.
Yes. These sources cited the strong signal sent when European regulators raided the headquarters of the e-commerce platform Temu, specifically citing concerns over unfair state subsidies from China.
A huge visible player.
Exactly. That action serves as a powerful testament to the EU's resolve to enforce the FSR.
So for companies looking to acquire assets in Europe or bidding on big public contracts, due diligence just got a whole lot more complicated.
Oh, absolutely. It dramatically increases M&A risk. You now have to proactively audit all past financial support to see if it gave you a specific, non-replicable advantage. And in many cases, you have to formally notify the European Commission before a deal can even close.
That is some intense external pressure. Okay, let's pivot, because managing all this external chaos requires a rock-solid internal core. Let's talk about combating global corruption.
This is where strategic compliance really separates itself from just ticking boxes. Building robust anti-corruption systems isn't just about avoiding a penalty. It's about guaranteeing the stability and reputation you need to secure investment and attract high-value partners abroad.
We often hear about the two big ones here, the FCPA and the UK Bribery Act. Most executives know they prohibit bribes, but what's the nuanced detail they often miss?
Okay, so the key nuance in the FCPA, the U.S. Act, is that it's actually two separate laws bundled together. Yes, you have the anti-bribery provisions, but you also have the stringent accounting provisions.
The books and records part.
Exactly. They require publicly traded companies to maintain detailed, accurate books and records and adequate internal accounting controls.
So you could violate the FCPA just by having sloppy internal accounting, even if no bribe was ever proven.
Precisely. A mislabeled expense, a slush fund hidden off books, those are violations, even without a direct link to a bribe because they fail the internal controls test.
And the UK Bribery Act is even broader.
It is. The UK Act covers commercial bribes between private entities, not just government officials. But the critical piece is Section 7, which creates a specific corporate offense for failing to prevent bribery.
That's huge.
It's massive. A company can be held criminally liable if someone associated with it commits bribery, unless the company can prove it had adequate procedures in place to prevent it.
So the C-level question becomes, what on earth constitutes adequate procedures in practice? It sounds expensive.
It's an investment for sure, but the alternative is far more costly. The sources outline that it boils down to 6 principles. In practice, this means clear, written policies, Regular training, safe whistleblower channels.
Whistleblower channels seem key.
They're often your first line of defense. And then, of course, mandatory enhanced due diligence on all your third parties, agents, partners, suppliers, all of them.
But isn't the current pace of change, especially with AI and FSR, making the compliance budget just this unsustainable black hole for most firms?
That's a legitimate concern. But the strategic insight here is that a strong internal compliance system isn't just a cost center. It's the engine for managing geopolitical volatility. It moves you from just surviving to strategically positioning yourself for long-term growth.
That's a great bridge. We've established internal resilience is essential. So let's connect that internal stability to the increasing chaos in the macro environment, the shifting dynamics of global trade.
Absolutely. The sources are really clear on this. The days of assuming wide open, predictable, tariff-free markets are they're fundamentally behind us.
Yeah.
Trade disputes are driving up costs, causing constant supply chain disruptions, and introducing this pervasive uncertainty into any long-term planning.
And we're seeing the European response to this uncertainty in what they're calling de-risking strategies.
De-risking is the EU's conscious strategic effort to reduce reliance on single countries, especially those seen as high risk for crucial resources or technology. They're targeting vulnerabilities in semiconductors, critical minerals, pharmaceuticals.
So for a global business, a simple, efficient supply chain is now seen as inherently fragile.
Precisely. If governments are de-risking, your business has to diversify its supply chains and channels at the same time. Strategic compliance means actively mapping your network, identifying alternative suppliers globally, and exploring different logistics to ensure resilience, not just efficiency, is your mantra.
Okay, now let's shift from the macro policy down to the micro impact, specifically on the people who make this all run, the expatriates. I mean, these are the professionals, the corporate teams who need extended stay solutions as they set up operations, manage compliance, and build those diversified channels, especially in the Asia-Pacific region.
And for those key personnel, particularly in major hubs like Shanghai, the tax burden can become an enormous and unexpected financial problem. We need to look at the complexity of individual income tax, or IIT, for foreigners.
The core challenge, I gather, is determining tax residency status.
Why is that threshold so critical? Because once that physical presence threshold is crossed, and it's a very strict day-counting exercise, the individual may subject their worldwide income to Chinese tax.
Their worldwide income.
Yes. For a high-earning global executive, that sudden taxation on passive investments, stock options, non-China income, it is a massive financial game changer. Companies relying on these professionals need to manage this exposure.
And this is exactly where detailed planning becomes essential for the employer. Companies need professional advice to make sure their teams, who are often in service departments or other corporate housing for long stretches, can operate smoothly.
Absolutely. The stability of your employee is tied directly to the stability of your company's operations. It's a crucial logistical and financial piece of the puzzle.
Now, you mentioned a specific high-value detail, the 6-year rule in Shanghai. We have to explain how this works because it's a vital way to reduce that tax burden.
This is an essential detail for HR and finance teams. The 6-year rule offers a significant tax advantage. It essentially lets expats avoid worldwide income tax if they manage their physical presence carefully.
Okay, so how does it work?
The rule states that if an expatriate leaves the mainland for more than 30 consecutive days or 90 cumulative days in any given year, the 6-year clock for continuous tax residency resets.
So careful planning of vacations, business trips, or even a temporary reassignment every 5 or 6 years can save a fortune.
Precisely. It turns the annual travel itinerary into a critical tax planning document. Compliance here, accurate residency tracking, timely filing, using tax treaty advice, is absolutely non-negotiable for both the employee and the employer.
This has been an incredibly detailed look at some really hidden complexity. We've covered everything from algorithmic bias to expat tax loopholes. So what should be the final strategic takeaway for the executive listening right now?
I think it means we have to discard the old notion of compliance as just risk management. The regulatory environment is complicated, it's constantly shifting, and yes, it's demanding, but ignoring it is no longer an option for any durable business. Compliance is the new prerequisite for market access, for operational stability, and for attracting high-quality investment and talent.
So reframe compliance as a strategic long-term investment. It's what unlocks the opportunities in these high-growth, high-regulation markets.
Which leads us to our final provocative thought for you. Given the rapid and retrospective nature of new regulations, like the FSR looking back 5 years, and AI governance changing your risk daily, what specific steps can you take this week to audit your current internal systems and move your company from a reactive compliance posture to a truly adaptive and future-proof one? Something to keep top of mind as you plan your next move.